Good morning, everyone. My name is Carl Grund, and welcome to the fifth installment of Coffee with Carl. Today, I have the pleasure of having Chris Dilon from T.Rowe Price Multi-Asset Group. Welcome, Chris.
Thank you, Carl. Good to be here. Looking forward to my Coffee with Carl.
Appreciate it. Thanks for stopping in. So today, we're going to keep the theme going here and just talk a little bit about the stock market and what T.Rowe Price is seeing and where you guys are seeing for opportunities, throughout the rest of the year, and then what challenge you guys may see, because I know the election's has become a big theme, as well as the vaccine conversation.
So, Carl, sitting in multi-asset division at T.Rowe, and for those not so familiar with T.Rowe Price, global investment management firm known for active management, managing $1.2 trillion in assets. Where I sit in the multi-asset division, it's about $340 billion of that $1.2 trillion. So think retirement date funds, think target date funds, think globally diversified portfolios for investors. Think of neutral as a 60% global equity portfolio, 40% global fixed income portfolio. Neutral, 60-40 against that construct. So we began the year neutral, Carl. Didn't foresee the pandemic. I don't think anybody did, the severity of it. We were of the mind that you had a recovering economic scenario from 2019, and that seems like a million years ago, but there was actually a global manufacturing recession exacerbated by a trade war that almost looked like a recession was going to happen in 2019. Well, the Fed stepped in, 100 rate cuts from global central banks last year. 2019 was ending, gentle kind of updraft to the global economy. March hits, late February hits, COVID-19 hits. We all know the story, record domestic equity index levels, goes bear market in a matter of 2 weeks. March 23rd comes, Fed steps in, global central banks step in, Washington, D.C. steps in, and the market's up 53% since then. So that's just a long-winded way, and I'm going to get to your question here, I promise, but this is the backdrop to get there. But the market's up 53% since March 23rd. That's a long way to come. We began the year neutral. Into that carnage that was happening in March, we got overweight stocks. So again, back to neutral, 60-40. We were at 63.5, maybe even a little more if you think of equity beta tilt, emerging market equities, small cap overweight. Our beta was even more than that 63.5% overweight. And I'm talking about, portfolio kind of sitting in the middle of our risk reward spectrum. Max risk budget there, 65%. So 63.5%, it's a meaningful move for us. Well, that's where we were back in March. Took advantage of that opportunity, got to ride along with this 53% plus we've had since March 23rd. But here we are, and we're back to neutral, Carl. So, you had the Fed, enormous amount of stimulus. Fed's balance sheet goes from $4 trillion, $7 trillion. Fed funds is zero, expected to be there probably out to 2023. Pretty accommodative. Besides that, other central banks around the world have also stepped in. We've aggregated total stimulus thrown into the global financial system at about $25 trillion. The entire value of the world stock market is maybe $48 to $50 trillion. It's an enormous amount of money that went into the system. Well, that goes in, market's up 53%. That's the answer to that question. Second quarter U.S. GDP was minus 32%. How can the market be up that much? The answer is that amount of stimulus. Well, Carl, here we are now. I mentioned we're back to neutral now, 60-40. Part of our reason for being neutral after such a run, it could be rationale for, God, I got to take some, I need to take some back off of that after 53%. But it's still a lot of stimulus pulsing around the veins of the global financial system. But we also recognize the following. One, the Fed's kind of on pause here, waiting for some fiscal policy help. We got the CARES Act spring from Washington, D.C., but with posturing before the election and now a focus on a new Supreme Court judge, it seems like the focus is off additional extension of CARES. And, the market's feeling that. There's kind of this lull here, almost this dead zone, if you will. So the market's been kind of choppy, sideways, oscillating September, October. There's good days, there's some bad days, but sideways, we're back to neutral. So in this uncertain time period, what needs to change for us to maybe get back to overweight stocks, Carl? And I think, the answer is, one, we need an election outcome. So that'll be one. I'm sure we can talk about that. But the other would be, is there going to be some additional fiscal help? And I guess the third thing would be, where are we with vaccines? So we got overweight in March, back to neutral. And I think for us, as we're thinking of the world and the road ahead, we do think a vaccine's coming in 2021, and I'm sure we're going to get to that part of the conversation. We have to be thinking of what does the world look like 6, 12, 18 months. We've tilted a bit towards value. We've already been overweight small caps, but cyclicality risk, those parts of the market that will be tied into the economy. I mentioned minus 32% annualized GDP in Q2, enormous trough to come out of. But as we lift out of that, you could have economically cycle sensitive parts of the market really take off here. So back to neutral, but an emphasis, on value, cyclicals, small cap, and more of a secular strategic weighting on emerging markets. I've not just said a lot. You asked me a question, and I just did a walk around the world. I feel like I need to pause here, Carl.
You did a great job. That was a great overview. I think you highlighted a number of different key points that people like to talk about and they want to really focus on. We can go into, I guess, as far as between now and the end of the year, talking a little bit about what is your guys' biggest concern? I mean, is it the election or not getting stimulus? And what's your as far as expectations for stimulus? If you guys don't get it, what do you think that means for the market? Are we talking a 5-10% drop, or do you think it'll happen if Biden's president a couple months in? What are your expectations as far as stimulus? And do you think that will be the biggest driver in the short term, or more so the election?
So I think a couple of things there, Carl. A lot packed into that question. So let me do my best to unpack that suitcase. So I think one, let's talk about the current moment here. Here we are, just less than a month to the election. So there's going to be the election, and it may not be an election night. It may be an election month. The COVID-19 has emphasized or accentuated the need for mail-in balloting, and there's been questions raised about mail-in balloting, whether that's valid or not. That's not for me. That's not for me to say. Well, what is to say though is it's not going to be an election night. You're going to have a directional message that goes into the election that evening, but mail-in ballots are going to have to get counted. It could take 3 weeks to 4 weeks for that to happen. Markets don't like uncertainty, and if that is the scenario, then to us it feels sideways, choppy, oscillating. Also mention, markets were anticipating in addition to or extension of the CARES Act. We expected to get that in August. It hasn't come, and the closer we get to the election, the less likely it is to come. And I'd have to say, as I'm reading the tea leaves at T.Rowe Price right now, and now that we're solidly into October with the election looming, closer we get, the less likely that is to come. Although, that's a fluid situation, but in an uncertain scenario, probably not coming. So with election uncertainty, fiscal uncertainty, we're sort of in this dead zone after this 53% run in the S&P 500. So to us, we've been saying this term. So Sebastian Page runs our multi-asset division. Heard him on television. I've heard our CIO, Rob Shartz, say the same thing. Not a time to be a hero. What do I mean by that? Good time to be neutral. Neutral, 60% global equities, 40% global fixed income. We could have a data point that comes in. Vaccine gets breakthrough next week. You don't want to miss out on that. Could also have some negative news, and that could drag you down. So you want your bolster stability on the other side of that. So right now, neutral, Carl, is where we are. But I think you also talked about, besides this dead zone, and to us, this dead zone, oscillating, choppy, sideways, sloppy. This could run till the end of the year until we get definitive outcome on the election, and then we can start looking ahead to 2021. And why don't we get to that? We are optimistic at T. Rowe Price that vaccines are coming. They're coming next year. And I mentioned vaccines, not a vaccine. I think the point to emphasize is, testing has been not the most even process in the U.S. I think you could argue pretty bad execution from the testing of COVID-19 in 2020. And if you have that backdrop, who's to say that a vaccine comes and then you're going to have this nice orderly dissemination across the populace? There's going to be more than one vaccine. And I think the point we're emphasizing on the vaccine front is not any one of them will be a perfect silver bullet. There's not one magic remedy to COVID-19. I think the other thing about the vaccine is there are complexities with regard to vaccine dissemination. What do I mean by complexities? Well, Some of the vaccines need to be stored at minus 20 degrees Celsius, if not at a more extreme temperature, and they have limited shelf lives of maybe 2 or 3 days. If that's the case, think about that. Logistics are going to need to get figured out. This is going to take a while. But I think our message, bottom line, is we're thinking of the world 12 months and beyond is the way we need to think about the world of T. Rowe Price. Is it going to be a nice, orderly process? No. Will the United States figure it out? Yes. World Series 2021, played in front of a full stadium potentially next year? Yes. So we figure it out. So I guess as we're thinking ahead, past this dead zone of where we are with this uncertainty on election, no more fiscal, but what's coming? Vaccine comes, U.S. economy reopens for real next year at some point. I mentioned $25 trillion of stimulus sloshing around the veins of the global financial system. You ignite that with a real economic recovery and a return to normal activities in the U.S. economy. I think, Carl, the road ahead is I anticipate us getting back to overweight in equities, but I'd also say our emphasis would be right now we're modestly tilting towards a overweight in value. We've already been overweight in small caps. Less emphasis on growth, but more on small cap value. So I think the point is value is where we're tilting. It's where we're tilting right now, but I'd expect that to become even more next year with the reopening of the U.S. economy once we get past this dead zone right now, Carl.
Okay, so you talked a little about the dissemination of the vaccine. Under a perfect scenario, we're able to do it in summer of next year. What does that look like for projections for maybe the S&P 500? Give the viewers a little bit of understanding of where we are today versus where that might be. And then on the other side of the coin, let's say there's a lot of issues with it, and maybe we're not able to actually get the vaccine out to the masses until really winter, if not 2022. So
hard to prognosticate on returns in the S&P 500. I guess, and I say this, I'm not running for political office, Carl, because I'm not going to give a clean answer to your question. But let me just preface the reason why I'm backing off a very clean answer. So if you think of March 23rd, and the markets as we're here in early part of October, mid-October, why don't we call it, and the market's up 53%, but U.S. GDP was minus 32% annualized in Q2. Q2 earnings in the S&P 500 were minus 35%, but the market's up 53% as we're approaching mid-October. So how do you reconcile that? Well, I said 25 trillion in stimulus was the filler, if you will, that bridge over that chasm of that wall of worry, if you will. So now think about our business and think about what we do in our business. If I said S&P 500 earnings were minus 35% in Q2 of this year, that's a comparison to what those earnings were a year ago. So now think about 25 trillion in stimulus. It came this year. Well, what happens next year? Are we going to get another 25 trillion in stimulus? Probably not. What's going to need to happen is that minus 35% earnings of the S&P 500 is going to need to recover in conjunction with economic recovery. So which one's more powerful? Fiscal stimulus or a recovery of earnings in the S&P 500? I think when you do that balancing act of the two, which one's more potent? I think we just found out that stimulus lifted the market 53% with no earnings. So if it's a relay race, so we're trying to hand the baton off over to a more conventional investment environment, and it's going to be earnings and it's economic recovery, we're not anticipating anything like 53% that we've had since March 23rd. I think our expectation would be somewhere of what you'd expect long-term from the equity market next year, potentially 6 to 10%. But what drives that market? It may not be growth and high tech in the U.S. That's been driving for the past 10 years, and it's been accelerated forward in this 2020 environment. What may come next year, those parts of the market that have been left behind. That's where I keep bringing up value. I keep bringing up small caps. And I think if you get global economic recovery and then think about a place like China, first into COVID-19, but first out. They are back up and running. So emerging markets in a global economic recovery, got to be thinking about that as well. So I guess, Carl, to answer your question, if you get that economic recovery and you get a return of earnings growth and a return to normalcy, more normal environment, expect 7 to 10% from the market. But what's driving it? You will not have this enormous chasm between growth performing up here, value performing up here. Think about, tech coming back down to earth, and think about those other parts of the market that have been left behind, surging back up. So I guess 7 to 10%, but underneath the surface, a very interesting story, Carl.
Okay, so no, that's great. I guess one of the big things that I would have a question on is really on the election. How's that under a Biden presidency and potentially a blue wave? There's real concern about removal of a lot of the favorable tax code. So how would that muddy up some of the different growth prospects you guys are forecasting?
So complex conversation, and let's be clear, we need to be politically agnostic in this conversation. But I've mentioned before, I'm not running for political office, so I'm going to answer your question. So let's answer your question. So we had tax reform late 2017, corporate tax rate in the United States, and it needed to happen. 35%, one of the most egregious tax rates in the world. Almost having U.S. corporations fighting with one hand tied behind their back. But we're down to 21%. I think you do back of the envelope math on tax reform. And when it came, you would argue that added about 20% to the stock market, with a corporate tax rate dropping from 35% to 21%, just based on the math in terms of discounting cash flows, more net income because of lower tax rate. So now, if you do get a blue wave, does some of that tax reform get pulled back? The answer to that is absolutely yes. And I think it's a blue wave. It has to be a blue wave. It has to be Biden, and it has to be a blue sweep of the Senate. So it's Democrats in charge of all Washington, D.C. Not an anti-democratic statement that we make. The United States is running $3 to $4 trillion deficit this year. Can that continue into perpetuity? Answer to that is no. Growth, economic reacceleration of growth can help offset some of that deficit, but you can make an argument that taxes do need to go back up. But so what do I mean by taxes going back up? So corporate tax rate went from 35% down to 21%. It looks like Biden's proposal could take that out to 28%. So let's think about this relative to S&P 500 earnings. It aggregates to a number. In the end of 2019, that number was 168 in earnings for the entire S&P 500. If you aggregate all of its parts, that's probably going to drop down to about 125 to 130 in 2020 because of the pandemic. So in an economic recovery, when do we get back to that 160 range on earnings? Probably sometime the end of next year, maybe midway through the following part of the year. So 160 in earnings, corporate taxes go from 21% up to 28%. That 160 becomes maybe 148. So just, again, discounting of cash flows, that's a headwind for the market. But something else you could get from a blue wave would be a relaxation of tariff policy. So when I say relaxation of tariff policy, that takes money out of the pockets of the companies in the S&P 500. Back to that 148. That 148, you could actually add 8 to it, get to 156 instead of 160. So it's not as clean as all that. The other thing would be, there is talk with the Biden camp of additional infrastructure build out, more fiscal, more government spending, different drivers for the market. Again, I keep talking about cyclicality. Those parts of the markets left behind. You get a fiscal pulse and an infrastructure build out that could get a lift to a different parts of the market. Back to that relay brace. Not a time to be a hero. Being neutral in your asset allocation construct. So I think, Carl, it's a complex question. A blue wave, more taxes, yes. Infrastructure build, probably. Relaxation of tariff policy, more than likely. Add it all up, it's just different drivers of what's driving the market. More regulatory risk come with all that, but it's complex, Carl, and I don't think it's just as clean as just taxes are going to go up. Oh my gosh, that's terrible. There's more to it.
And you mentioned earnings on the S&P. And where we get to the final, 3,300, 3,400, 3,500, obviously is putting a multiple on that earnings number. What have you guys seen? I know we were tracking on 25 and 26. With the amount of fiscal stimulus that's in the system, what do you think would be a fair multiple as far as earnings right now?
So it's interesting. We've been having this conversation because you're seeing the articles show up in the Wall Street Journal, you're seeing in the Financial Times, any financial publication is talking about hey, is the market expensive here? Is it 1999 all over again? Market got pretty expensive in 1999. So I think the multiple, as we're looking at it, about 27 times price to earnings. So price of the market versus the earnings, about 27 times. I guess your long-term average for that, Carl, and I may be off on this a little bit, you'd expect normally 18 to 20 times in a normal environment when we throw that out. So does that appear expensive? It certainly does relative to long-term averages. But Carl, during this conversation, one thing I mentioned was second quarter 2020 earnings for the S&P 500 minus 35%. That is a steep drop in earnings. I mentioned 168-ish in earnings last year. It's probably going to be 125 to 130. So back to the market valuation, price to earnings. So price divided by earnings. Well, earnings have dropped, and you have the stimulus in it that's kept the price of the market up. But doesn't that, by default, just by the math of it, make the market more expensive? I think the answer to that is yes. So I think you think of those cyclically sensitive parts of the market as their earnings recover. And if you get to the other side in a reopening in the U.S., you get the vaccine. As those earnings recover, you get the fiscal fade, the earnings recover. So back to answer your question, Carl, where should we land? 20, 22 times is where we should probably land. And why do I say 20, 22 times, maybe a little north of 22 times? 25 trillion of stimulus hasn't evaporated yet. It's still working through the system. So it is an accommodative regime, if you will, from an environment standpoint. Fed funds is zero. You have all this extra stimulus sloshing around in the system. And who's to say we don't get some additional fiscal stimulus along the way? It's accommodative with an earnings recovery. That's where I think the market will give a better than average multiple, Carl. 28 times, expensive, yes, but big, I guess, caveats around that, if you will. Complicated environment.
Mm-hmm. No, that's a really good explanation. One of the other points you touched on during that is China. And that's been a rising concern, right, as the rhetoric between us and China has increased more recently. What are your expectations for our relationship with China, moving forward? And then secondarily, what might be some ways to invest in China, emerging markets, where you mentioned that as an opportunity space?
So right now, I think it's tough from the China perspective, and it's not going to go away. But let me just explain the current environment right now. And I think about it as, we don't know who the next president's going to be. But with regard to President Trump, the Trump administration has not handled COVID-19 well. I mean, President of the United States has COVID-19, just to speak to the point. Why do I mention this? I mention this in terms of, if you're trying to get reelected president and COVID-19 isn't going well, and there's questions around that, you can try to take the blame off of that, or take the focus of that away and point at the bad guy across the Pacific Ocean in China. And let's talk tough on China. Let's say China sent COVID-19 over here, and let's not get into all that. But the point is, let's just blame China and be tough on China to get reelected president. There's an element of that here right now. So I guess a couple of things. One, it's a bipartisan position to be tougher on China. And I guess from T.Rowe Price's perspective, we are researching global industrial companies, global multinationals from a bottom-up perspective, and seeing different companies going into China, what they had to do in terms of opening up their vault, if you will, to their corporate, their best kept secrets from a corporate standpoint, having to open that up to be in the market in China. There are real questions, and this doesn't come out of nowhere. Operating in China and intellectual property theft was a reality. Did the U.S. need to get tougher from the Chinese perspective? Absolutely. Has it been amplified to get President Trump reelected president? Yes. If President Trump were to get reelected, would he take some of the pressure off, some rapprochement with China? I think our thought is yes. And I think we say that against the backdrop of, pandemic, COVID-19, medical supply chains, heavy dependence on China. Does that need to get reconfigured? Yes. But can all supply chains supporting global multinationals just simply pivot away from China? Our answer back to that question is absolutely not. China has invested in people. They've invested in infrastructure. They've invested in urban centers that has made it very easy for global multinationals to operate a complicated global global supply chain serving global multinationals. Can we just, pivot away and move to Vietnam, move to Malaysia, move to Thailand? We know the answer to this question. The answer is no. There's going to be an uneasy truce that settles somewhere in this continuum of U.S.-China. It gets, I think, some rapprochement with regard to Trump, if it is Trump after this. From the Biden perspective, it'll be different, still an uneasy truce, but I think either Democrat or Republican, is it the way it was for the past 20 years, where let's just trust China and be very fluid from a global multi-supply chain perspective? That ship has sailed, but some kind of uneasy truce, I think, is where we land, and it's Republican or Democrat either way, Carl.
Mm-hmm. I guess speaking to the international space as a whole, are you guys more leaning towards the emerging market space or developed?
So
as the best option?
On your past question, you said, where specifically in EM, and I didn't answer your question. I kind of got lost in that U.S.-China, but let me take another step at that. I've mentioned that, T.Rowe Price multi-asset, we've been overweight for emerging markets for some time. We keep that overweight in play. But I'd say, there are parts of emerging markets that have not handled COVID-19 very well. I would look at Latin America as a case in point. I think when I'm speaking about emerging markets, I'm talking specifically about North Asia, and I'm talking about China. In China, there is you've got a big developing consumer story theme that's happening. They are very much ahead of the U.S. from an e-commerce perspective. You have your Alibaba, you have your Tencent, and you've had this e-commerce wave take over the main urban areas in China. Well, that's happened, and is there concentration in Alibaba, Tencent? Absolutely. But the next push, I guess the next derivative of China, are the second-tier cities. They are getting connected. There is a consumer story there. So it's Alibaba for sure, but there are some other entities that are going to build on that e-commerce platform as second-tier cities in China get online, if you will. There's also a big push for education, online education. There is one of our stocks related to that, very much on that theme. So I guess, Carl, I didn't answer the question from before, and now I'm going to come back and maybe ask you to ask me your question again, because I didn't answer your last question. But specifically on emerging markets, it's North Asia, it's China, it's e-commerce, it's tech, and a rising consumer theme, just to answer your question, Carl. It's not just blandly broad EM. It's very targeted specific around the Asia complex.
Do you see opportunity just in the more developed international space as well? With the dollar drop, that should help some of those countries perform well.
So, Carl, you make a great point. So, it's been a strong dollar environment really since 2011. That was the Eurozone debt crisis. Ever since, it's been a really strong U.S. dollar environment. And if you're sitting here in the U.S. and you're invested in international stocks, that is a big block of kryptonite on international stocks. So, Carl, you mentioned weakness in the dollar. In March of this year, 2020, something called the DXY, the Dixie, that's the U.S. dollar index. That got to a really strong number. When the world's uncertain, there's a big demand for U.S. dollars. And that big demand for dollars took that DXY to around 103. As we are here in mid-October, that DXY is down to 93. So why is it down to 93? That's a big drop in the U.S. dollar. And where do we go from here? I think from our perspective, it continues to be dollar weakness from here. This would be very supportive for international stocks. But in terms of answering that question, why dollar weakness? So one, we've talked about the response to the pandemic. I mentioned Fed funds at zero and potentially at zero out until 2023. Other central banks around the world, probably not as aggressive. Just that difference in and of itself creates a trajectory for dollar weakness. So let's just get to the point of international stocks. Are we neutral international versus U.S.? We are right now. We haven't been. We've been favoring U.S. for the past 10 years. We're neutral. One, they're cheaper from a valuation standpoint, but two, this cheaper dollar or weaker dollar theme, we think this lasts. And what can this mean mathematically? 2017 was a year of dollar weakness, and it was a great year for global investors, but let's frame it. Big year of dollar weakness. S&P 500 in 2017 was up 21%. International stocks were up 30%. Emerging markets were up 40% that year. So, Carl, you bring up the dollar. Huge point. We're expecting not a free fall of the dollar, collapse of the dollar, but weaker dollar, cheap valuations, recovering global economy. This all sets a pretty good stage for international stocks, Carl, not just Asia, but just holistically as well.
No, that's great. So, I mean, for you guys really looking to the value space, international and small cap, would you say the three main areas of opportunity for you?
Would. And the small cap, even a tilt stronger to small cap value to just get that extra, I guess it's addressing cyclicality risk. You get the recovery. When the U.S. comes out of an economic trough, cyclical asset classes, value, small cap value, that's where the biggest bang for your buck is if we are correct with this scenario of a vaccine and a reopening in the U.S., Carl.
And then I guess one of the last questions I have, you've talked a little bit about the 60-40 allocation. Where are you guys looking for opportunity? Because interest rates are presumably going to be low and stay low for quite a while. So how are you guys managing that 60-40 allocation, and what other areas of the market are you really looking to augment the low returns that you're generating on the bond side?
So a couple things, and Carl, we agree with your what you said and with regard to rates. I mentioned Fed funds. Right now, the market thinks Fed funds is zero out to 2023. That's considerable time from here, obviously. But it's not just about Fed funds. 10-year Treasury yield is now hovering somewhere between 60 basis points and 80 basis points. We think that's the range, and we think that's the range for potentially the next couple of years. If that's the case, think about the luxury we've had as U.S. investors for the past 20 or 30 years, where if your equity market allocation wasn't doing well, you were getting a nice yield from treasuries, and you were also getting principal appreciation. Those bonds would go up in price when you'd have trouble in the equity markets. So fast forward to today, which is the nature of your question, it's low yields, and can they be sticky there? And is it just a sticky asset that doesn't sell off? Is that okay? It is, but is it a perfect answer for a 60-40 portfolio construct? The answer is no. We have to think differently about this allocation, which now let's get to answer your question. So September 2017, T.Rowe Price multi-asset division, if you looked at our fixed income, 75%, Bloomberg Barclays aggregate bond index, your core bond index. But we were looking at that in 2017, and since the global financial crisis, it had become very heavy U.S. government. Now, we didn't anticipate that rates would get as low as they have, but it is 75% to 80% U.S. government. I think for us, now that we've landed where we landed from a rate perspective, September 2017, we took that ag component. It's not 70% anymore, it's 40%. And so I should finish the thought. You're 70% ag, and then you'd have high yield, emerging market debt, plus sectors to round out that fixed income. We're still using the plus sectors, but the ag, no longer 70%, now it's down to 40%. So you got to fill in the middle. It went from 70 to 40 on the ag. So what replaced it? A couple of things. So one would be liquid alternatives. So it's a global dynamic bond strategy at T. Rowe Price that we're using in there. This is absolute return fixed income using a global opportunity set, having some put options on the S&P 500. Remember I said fixed income? We've had this great luxury when your equity market allocation wasn't doing well and you get a boost from treasuries. If we're just sideways in treasuries, you're not getting that anymore. But if you have a global fixed income, absolute return orientation, it's not overly aggressive from a risk budget standpoint, you get creative and you put some put options on the S&P 500, you can synthetically create, you're not going to perfectly recreate what we've had from treasuries. That ship has passed. But can we get something that's absolute return oriented with a conservative risk budget while also giving a negative correlation to equities? We can do that. We've done that in fixed income, Carl. So some alternatives make sense. Dividend paying equities, leaning on that and not thinking of that so cleanly from an equity part of your allocation, but given the income part of it and thinking of that risk budget wise as part of your fixed income. That's a conversation as well, Carl.
Yeah, and I tend to agree with you. I think looking to some of these different alternatives is really where you're going to have to look, at least to generate some return and then also put some protection to the portfolio. So that makes a lot of sense. Well, I think that's go ahead and wrap it up today. Chris, definitely appreciate your time and your insight into the market and where you guys are seeing for opportunities. and certainly look forward to chatting with you again sometime in the future, hopefully.
That'd be great, Carl. Thank you. Thanks, everybody. Be well.
Yeah, take care. Bye-bye.